Hello, everyone, and thanks for joining the Q3 Fund Flow Wrap-Up. My name is Dave Lubnick, and I'm joined here by Anthony Hayes. We are on the asset management team at YCharts. Excited to be hosting this quarterly review of flows for the third quarter, as well as September in particular. A number of you have probably joined these in the past, as we've been hosting them quarterly for about the last year or so, and excited to dig into some interesting statistics here. For those of you who would like to submit questions, encourage you to do so through the chat feature of the presentation. For those of you that registered, you will be receiving a recording afterwards. Feel free to leverage that, pass that around to others on your teams that might be interested in looking at it. And if you'd like to view any of the fund flow reports that we're going to be talking about here, if you are a YCharts subscriber, you have access to that through the support dropdown in your subscription. So without further ado, let's dig in here. First off, let's set the scene. So we had a pretty interesting third quarter. Obviously, the Federal Reserve was active with two different 75 basis point rate hikes. As part of that, the U.S. 10-year Treasury rate increased from a low on August 1st of 2.6% up to nearly 4% at the end of September. And as we sit here today, it's north of that, closer to 4.25%. With that, inflation was all over the place, up and back down a little bit and then back up. Mortgage rates increased significantly throughout the quarter from about 5.5% to nearly 7% at the end of September. And we've seen that drift higher since then. The VIX, again, elevated, peaking in the low to mid 30s, which is quite elevated for that indicator. And overall market performance was pretty poor. Dow Jones Industrials led the way on the downside with about 6.2%. S&P 500 negative 5% for the quarter, and then the Nasdaq was actually the leader at about negative 3.9%, in due part to a relief rally that we'd seen from mid-July to mid-August before everything kind of crashed from there. Fortunately, we have had a little better performance in the last week and a half here. The other thing we're going to talk about is at the end of the presentation, the new fund data pages that we have available in YCharts, which are pretty exciting. So with that, let's dig in. So Anthony, you want to set us up with the Q3 broad asset class flows that we saw?
Absolutely. And thank you, Dave. You did a great job setting the scene there. And as you can see on your screen here, we're going to look at the inflows and outflows of broad asset class categories, including equities, fixed income, alternatives, and others. And based on Dave's comments, given the dramatic increase in interest rates, spike in volatility, there was no surprise. We saw inflows indicate a flight to cash, with money markets leading the way, indicated by the purple bar on the left side of your screen there. We saw that with $22 billion in inflows over the quarter, and general fixed income leading the way with over $34 billion in outflows. Given all that money that went into money markets, it is interesting that yields on money markets in the United States are still only averaging around 0.25% to 0.5%, but that did not stop advisors from piling money into them, hand over fist. And then lastly, it seems that investors were trying to do anything to salvage their traditional 60-40 portfolio by investing in traditionally non-correlated alternative investments, which saw inflows into that category topping $4.7 billion.
Yeah, another thing I'd add here is everybody take a second to look at that red column, negative 34 billion out of fixed income. And as Anthony flips the slide here to just September, keeping in mind that number, look at what fixed income did in just the month of September. It was out over 48 billion. So what we're looking at then is actually the fact that in July and August, fixed income saw inflows of about 14 billion. But then in the month of September, everybody headed for the doors in fixed income and pretty much every broad asset class, with the one small exception of alternatives. So September across the board really saw the outflows for mutual funds and ETFs.
And that's a great 30,000 foot view of the broad asset class categories. And then here, we're going to transition to Q3 equity style flows. You can see we've broken this out via the 9 equity style boxes. And this slide indicates those Q3 flows into both mutual funds and ETFs. And you can clearly see, as indicated by the large blue bar on the left side of your screen, that investors favored large cap companies versus mid and small cap, with large blend taking in over $30 billion in Q3, and then large value coming in a distant second with a mere $3.3 billion of inflows. The only other category in net inflows within the 9 equity style boxes was mid cap value, which traditionally has great risk adjusted returns, and you still only saw under $1 billion in inflows there.
Yeah, and the other interesting thing here to put in perspective, as we've been doing this for, like I said, about the last year or so, is that it's always all about large cap. It really puts it in perspective that small and mid pales in comparison to the movements that we see in large cap. Large blend seems to consistently be the style box where we do see the most inflows over the last year. And then when we look at the next slide, I love this slide because this is breaking it out between mutual funds and ETFs. And this is another consistent theme that we've seen. It is the fact that mutual funds, regardless of which style box, in this case, all 9 style boxes, are seeing outflows in the third quarter, while ETFs kind of across the board are seeing inflows, with the one small exception of the small cap space, but those numbers are pretty much close to zero. But you do see those very large numbers for the flows into ETFs. And I think that's interesting to reflect on what we've seen from a lot of the asset managers we work with, which is the continuing focus on ETFs for their sales teams, continually launching new ETFs. Either they've never been in ETFs and they're launching an ETF lineup, or just continuing to diversify their ETF lineup, because clearly these flows state to the fact that if you want to see flows right now, it needs to be in the ETF space more so than the mutual fund space.
Now, and this is the last 2 slides. We've looked at equity flows via the 9 equity style boxes. I think this is another great way to look at the flows into equities. And here you can see we're digging deeper into the breakdown of specific equity sectors during the third quarter. And with mortgage rates increasing from 5% to almost 7%, which indicates almost a 25% increase in Q3 alone, and with the housing market slowing down dramatically, we did see the real estate sector experiencing over $5.3 billion in outflow, as indicated by the dark maroon line all the way to the right of your screen there. We also saw the interest rate sensitive tech sector not far behind, with $4.1 billion in outflows during the quarter. But if you shift your gaze to the left side, there were 2 bright spots for the equity sector, and that did include utilities, typically higher yielding, higher cash flow, and then consumer defensive. And both of those experienced $2.6 billion and $1.1 billion in inflows, respectively.
Yeah, that's interesting, Anthony. When we look at performance for these sectors in the third quarter and we see those flows into utilities, I couldn't help but look at the performance of the utility sector in the third quarter using YCharts for that. And it came in kind of middle of the pack. So it wasn't the best, it wasn't the worst, but that flight to quality and safety with the higher dividend yields in utilities, they held up reasonably well in the quarter. Shifting gears now to looking at fixed income and looking at those sectors, you see a pretty interesting chart here. We see short-term bond on the far right in the green leading the way with outflows, long government in the far left in purple. So really a bifurcation here between the duration of these securities and what saw the inflows and the outflows. The other thing you'll notice is the flight to quality with core bond in orange, seeing much better from a flow perspective than core plus. So probably nothing too interesting here or I should say unexpected, given the Fed's very vocal stance of raising rates and where short term then has seen the outflows from this space.
And then even expanding on overall Q3 flows, it is interesting to see that the overall flattening of the yield curve, you really saw a ton of money flow into ultra short and short government bonds in the last quarter of the year. And that's indicated by the purple on the left side and then the orange as well. You saw inflows of almost $11 billion go into ultra short and close to $4.5 billion go into short government bonds. So it's interesting to see, and investors could claim that they're now getting paid on the short end of the curve without the interest rate sensitivity that comes with longer duration bonds. It's still only seeing ultra short funds yielding close to 1 to 2%, but that's compared to the last couple of years where it was near zero. And then if you shift your gaze to the right side of the screen, the risk off sentiment that we've mentioned continuously throughout this, it continued in September. And you could see that indicated by high yield and bank loan strategies suffering a combined $13 billion in outflows in September alone. And that's indicated by the brighter orange and then the darker navy bars on the right side of your screen.
Yeah, thank you, Anthony. The next slide, we're going to look at coupling together flows with performance. And I love this table here. It's taken right out of our monthly PDF fund flow reports to be able to look across the style boxes, in this case for equities, looking at what the flows looked like for September, for all of third quarter, as well as for the trailing 1 year, and then putting that side by side with performance. So a couple things to take away here. First off, there isn't a single style box that hasn't been spared from a performance perspective. It is interesting to note in September, the performance was pretty tightly packed together. Worst performing style box, small cap value, negative 9.8%, but the best performing style box, large value and small growth, tied at negative 8.6. So pretty tightly clustered there with performance in September. Obviously, as you extend the time frame, Q3, so you'll see a little bit more variance, as well as then over 1 year. I will note, looking back over a 1 year basis, it looks like the inflows to large blend have been justified. That has been one of the best performing style boxes over the last year. And that's where most of the inflows have gone, along with large value, which actually was the best performing style box over the last year, compared with mid cap growth and small cap growth, which had the worst performance and saw some of the biggest outflows.
Yeah. And it's, I know we've heard about it for years with growth outperforming value. I know a lot of value managers have been hoping for that trend to continue or to reverse itself. And you have seen a little bit, unfortunately, at this point in time, we're just talking about being down less than growth. So not exactly the environment that we're hoping to outperform in, but it is interesting to see that reversal of a rather long trend. And when we switch to this slide, we've hinted towards it throughout the discussion, but this is just going to show you the net flows of both passive funds and ETFs, those that are designed to track a given index, and then active strategies, those that employ active management with the goal of outperforming their index. And you can see that passive strategies, as indicated on the right side of your screen, gathered far more assets in Q3 when compared to active strategies. You saw passive funds take in over $100 billion in Q3 alone, where you actually saw active funds experiencing close to $170 billion in outflows. So short and sweet, Q3 continues to be a continuation of the trend away from active strategies and into index tracking, passive funds, and ETFs.
Yeah, it really is interesting. The fact that in this environment, this level of volatility in the media, people are talking about this is the time for active managers to shine and make their bets. The flows speak for themselves, and you still see the outflows across all, pretty much all active funds, especially the active mutual funds, and that's just surprising to me, honestly, that you're still seeing this despite this stock pickers environment and the volatility. And we've seen some really good performance out of some active managers, but the flows are still going pretty much exclusively to passive. So with that, I want to switch gears here for a second and show you a new feature in YCharts related to everything we've been talking about. So Folks probably know that we release new functionality in YCharts on a weekly basis. We're constantly innovating the tool. We've had a lot of great enhancements come out this year and a lot more to come. One of those new features is a revamping of a couple pages in the tool, and you'll find these under the data dropdown. We've revamped the ETF page as well as the mutual fund page, and we'll just focus on the ETF page for now. This is a great resource now, much better than it used to be, to get snapshots of what performance as well as fund flows look like for, in this case, ETFs, or like I said, in the other section for mutual funds. For those of our friends up north, you'll notice in the top left corner, you can drop down between the United States and Canada. And then as we scroll down here, to start off with, we have performance by style. You've got options to toggle between equity and fixed income, easily change your time frames there. And then each of those is a link if you want to explore that further. Scrolling down below that, we've got the performance by broad asset class, and you can toggle between allocation, commodities, municipal bond, US equity, et cetera. See which ETFs have had the best performance over your chosen time frame or the worst performance there. Below that is one of my favorites, which is this table focused on fund flows as well as performance. So we're looking here at some of the most popular categories, and you'll see some columns devoted to flows as well as performance. You can sort those by clicking on the header. But in the top right of that box, you can click on see all categories. That'll expand it to all of the categories, and it's just a great table to be able to look at, look through, click further into each category, again, if you'd like to dive deeper. So a lot of great information in one place. Remember, all that fund flow information is being updated monthly. Performance is all updated daily. So it's really great information at your fingertips. Hard to beat that accessibility there. And then below that, we've got the fund flows and performance here again, but visually. So you can choose your time frames. You can choose tabs between fund flow and performance. You can even edit your categories that you see there. So if you want to swap out some of those categories right there in the top right of the module, you can adjust the categories there as well. So a lot of great information, all right here at your fingertips. Again, it's there for ETFs, it's there for mutual funds, and it is just a great enhancement that I think is really relevant for everybody from wholesalers to distribution leaders as well as advisors. So with that, we want to thank you everyone for joining. We host these on a quarterly basis, like we mentioned. We will be sending out a recording if you'd like to pass that on to anybody else. If you'd like to see any training on anything we covered, please book some time with your dedicated account manager. If you're not a YCharts client, feel free to visit us at YCharts.com, sign up for a free trial, get a custom walkthrough of the tool, and we'll see you again in 3 months to go through what happened in the fourth quarter. Thank you all.